All right, that's working. Close that window. Why did it not close? That's strange. Something else. Okay. And TikTok, the final ingredient. All right, that's downloading. Okay, we'll go over to the market in just a moment here. This level 351.30 was below. Okay. So in pre-market, we actually broke pivot low on the Qs. Let me see if that's true of S&P 500. 500, excuse me. Pre-market, actually, we're opening below pivot low on the S&P 500. The S&P 500 much worse than the growth market. The growth market's been kind of strong comparatively. Oh, I gotta remember, I need a fucking selfie light. Let me just put a note over here. Okay, look at that later. Bob, welcome in. I'll pull up the YouTube, Twitch chat, and etc. Just give me a sec. Oh, no wonder I can never see it. It's hidden over there. Been people trying to talk to me, and it's making me go through one of those fucking CAPTCHA things. Come on. Select all the images with cars. It's really hard to see. Okay, that's a motorcycle. And some of these images are really tiny. Can't even see what that other one is. Do that on purpose. Okay. Can I fucking log in now? Alright, so what I'm going to do is make this a little thinner. I gotta make space for this other chat window. It's not really a spot to put it. Okay. Do you want to allow public? Yes, allow. Okay, I'm getting the TikTok up here, so that's the last little element of to do. That's a little bit different. Interesting. Camera format. Oh. Okay, go live on TikTok. Okay, cool. We'll be able to talk about the market in like 1 minute, maybe 2. If you follow me on Twitter, that's at Evan Evans USA. On Twitter, Evan Evans USA. Over on Twitter X, whatever you call it. I made a post this morning in response to what somebody had said about Qualamagi, saying that the time to be in the markets is when the 10 is over the 20 on the Qs, and the time to be out of the markets is when the 10 is below the 20, right? A little bit of the issue with that is that when we're in a base and we're in a chop zone, it's triggering, it's whiplashing back and forth and back and forth. But regardless, what I said was by waiting for the right market conditions, Qualamagi was up 200% in 6 months. So after the pandemic drop, he waited. He didn't try to buy the bottom. He waited until the 10 went over the 20. Once it did confirm that, then he waited for entries on his particular stocks, right? And when those triggered and it was still 10 over the 20, he then went on a 200% run for him. His gains were 200% in 6 months. That's 3x your money. So, but realize by waiting, which is what other people think they don't have to do. They think they can outsmart everything. They can fucking gamble in the meantime. But by waiting, he was up a lot more than 200% in 6 months. Because why? Because he had more money. He was up more money comparatively than you who do not wait. Let's say you didn't wait, but you did get in at the right spot when the 10 was above the 20, and you got that 200% run in 6 months. Well, you might have only got back to break even because you dug yourself in a hole for the prior couple months when you shouldn't have been trading. So waiting is a superpower in trading. Okay. And I continued to say, realize that by waiting, he was up a lot more dollars because he didn't bleed it all off in a high failure rate environment beforehand. Half of winning is capital preservation. Otherwise, you're only climbing back to where you started after digging yourself into a hole. And then somebody responded, Francesco Franvez on Twitter X said, so true, well said. Peter Brandt talks about, quote unquote, how much you keep being the hardest part of trading. So I replied to that with an interesting reflection, which was that, yes, that is brilliant. How much you keep is the hardest part of trading. I'd say it's all about, and I'm going on, I'd say it's all about sensing when the market and your stocks are at a higher risk for failure, as Qualamagi put it succinctly. That could be the top of an extension from a good entry in a good environment where the 10 is over the 20. Your instincts about what is high risk environment need to include that as well. High risk isn't just when you shouldn't trade or be in the market, but it's also when you should get out and take your money off the craps table. I think taking 50% off after a good clip is one of the first best ways you can defend your gains in that respect, and be ready to let the rest run in a green light 10 over 20 environment. From there, you need to defend your runner as well. I do notice that with high ADR stocks, very high ADR stocks, the moving averages might not be enough to stay defensive on that runner. It can jump you up to trailing the 8MA or 5MA necessarily. Or even bar by bar, which is when a candlestick makes a lower low than a previous the day before. Paul Tudor Jones, who you should look up and learn from, is a big advocate of capital preservation and taking no risk. So it's kind of funny because a lot of people think that in order to make big gains, Paul Tudor Jones is one of the greatest traders of all time, with billionaire trader. And a lot of people, a lot of newbies want to think that to make huge gains, you have to take huge risks. Paul Tudor Jones definitely puts that theory to rest. Instead, he waits for near riskless opportunities to pop up, and only if they offer something that looks like it could be a 5-to-1 risk reward opportunity or more. So that's extreme. So he's amazing. And, you can learn a lot from Paul Tudor Jones on taking risks. Um, yeah, he's one of the greatest traders. So look him up. But anyway, all of that said, there was just a whole bunch of nuggets in what I just said. It's number one, staying out of high failure risk environments, and to think of that as more than just one thing. To always be reading, has this entered a high risk of failure moment? And what is failure? Failure is the end of the move, or the failure is, something's moving, it's really not going to continue. It's at risk of failure. It's risk of failing out, risk of not working out. And it could be risk of not working out any further. So you're in a trade, and that's enough. You have to learn to be satisfied. Otherwise, you get to be this big fat, you're eating too much. You have to learn when to trade has made enough, and that you feel good in your tummy, and just snip it off. And then wait the next day. You ate that day, right? So you eat enough for a one day's appetite, and then have some more tomorrow. Wait it out. Anyway, tons of good nugget drops there this morning. Hopefully, some of you were able to listen to that and get something out of that for life changing. I mean, those were nugget drops. Some of those are nugget drops. But you can also follow me on Twitter if you don't already, or go look at my Twitter in case you didn't understand what I was saying. But there you go. Of course, we are under the 20 moving average right now. The 10 is under the 20 moving average. So let's take a look at the market now. So the market is currently sitting pre-market below. It inched on the growth market on the QQQ. We inched below up this pivot low in pre-market. Which is bad. It means it did break those lows. Not during market hours, sure enough. Okay, so that means a little bit of something. But it did in pre-market break those lows. And this morning we're basically opening at low or below Friday's close and lows. So we're gapping down. Now that could turn around and turn into a gap down reversal, and then kick off a run for the next several days. So there is that's interesting to it. However, again, this is not a green light type environment. If you can wait out this entire base and wait till January or February of next year, preserve your capital, you'll be a lot better off than guessing at these little runs, right? However, anyway, to just examine the market, the Qs are opening below Friday, gap down, and have already in pre-market broke a pivot breakdown low. And so we could easily be moving down to the 200 moving average in the next few days. But what's even more startling is that the S&P 500 is opening below that pivot low. Its pivot low. It is opening below that. And of course, it's gapping down and opening below Friday's low and close. So it's just, price has gotten even worse over the weekend, but the S&P 500, in difference to the growth market, is at its 200 moving average. However, it did close for the first time on Friday, for the first time in a long time, below the 200 moving average. When it does that after it's been above the 200 moving average for a long time, that's usually a trigger for bigger investors to realize to stay out of the market, that we might be heading into a bear market. Now, I don't fully believe that. I'm still on my thesis that we're in a base, and this is just a very corrective base. And stocks and prices and businesses are getting hit hard. Now, this week we have earnings on several big names like Google, et cetera, and we're gonna have to see how that comes out in the laundry here, and see if it affects the markets positively or negatively. We also have Jay Powell speaking again Wednesday after the market close. About 30 minutes after the market closes on Wednesday, Jay Powell will be speaking. We also have PCE and a couple other important. I think we have GDP on Thursday, the morning after Powell speaks. 30 minutes after the close of the market on Wednesday, the morning after, we then have GDP information. So Wednesday and Thursday, mostly Thursday morning, but after market close Wednesday, some cataclysmic level, very important, the most important information, economic data will be released. And then in between all that, we've got big players with their earnings releases going on. So this is going to be a dicey week. And you shouldn't really sweat trading anything. You just stay out of it all. But if you want to trade something, for example, this morning we've got LMDX, which looks like a pretty decent chart. If that's what you got to do and you can't help yourself, there you go. LMDX with a pretty nice pre-market intraday chart if you're looking for some high octane, day trading material. And we're also looking at HARP and GRTX for interesting, hot this morning swing trade possibilities. So we'll be watching those for possible swing trade opportunities. GRTX, if you can get over 25 cents, would be interesting. And HARP over another particular level. We'll be taking a look at those while the market is running. We've got about 4 minutes until the market opens. Somebody wanted me to take a quick look at Tesla. 2 people wanted me to take a quick look at Tesla. Let's take a look. Pulling it up. I mean, Tesla's down with the market, and it's been down. So, I mean, price speaks for itself. Price isn't just, random. It's moving down because there's something shitty going on with Tesla right now. Now, that'll improve later probably. But right now, Tesla's in the dumps. So, I wouldn't short it. I'd just stay out of the market, and I'd say that Tesla's not interesting right now. It's gotten too hammered. It usually takes about 3 months to de-hammer something like that. I mean, it could go up from here, but it's a very risky, tricky trading environment. You'd be putting your money at risk on when you could either be just preserving your capital or finding a much better opportunity. So I'd stay away from Tesla for the reasons that you just don't need to be playing around with it. How many of you are interested in staying out of the market until conditions improve versus finding something to trade every day? And yet, that's why you still show up every morning in front of the market. That'd be me. That's the way to go. You don't want to miss it when it starts, but you also don't want to get over-triggered every damn day. Preservation of capital. We had that speech a little bit ago. Very, very important for you to be ready with all your money, not half your money, when things go up 100%. Because if you're ready with half your money when things go up 100%, you're only back where you started from, and then it's over. And what do you got? Nothing, but you're back where you started from. And then the next few months will be losses and losses and losses. Great, Camille. That's the way to go. Wait for a great trading environment. That's what we're really waiting for. Or keep it small. Keep your size small, like 1/5 or 1/10 what you normally. And if you want to dabble around, you dabble around until the conditions say push nitro. Until then, you just take it easy. You take it very easy. You can do that. You can practice little jabs. Just keep yourself in shape and at the top of your game. But don't expect results. Go for 1/10 the risk, 1/5 the risk, something like that. A huge differential, not half the risk, not a third, but a fifth or a tenth. So it's just unimpactful. Because it's not going to work out. I can just tell you that right now. It's not going to work out. You can't make stocks go up if they're not going to go up. And you need at least 2 days of follow through in order for swing trading to work. Because it has to go up and then it has to go down to where it triggers an exit. And you need 2 days of follow through just for it when it comes back down to trigger an exit at break even for that to work out as a break even trade. Otherwise, you're losing money by it going back to its stop. And you can't get that kind of follow through in a bad market environment. So 1 day does not make a good swing trade. One day doth not swing trade good make. Whatever. All right, LMDX. All right, the market's opening in 30 seconds. We're watching LMDX, for example. If it were to break this inner pivot level of 37 cents, and by the way, ideally you want to stay over stocks that are $1 or more and have an average volume of at least 400,000, if not 1 million shares per day. Having a low float is fine, but they need to be priced up in the range where institutional buyers and accredited investors and big money can get on board. Otherwise, they're legally not allowed to put money into it. And so it's just not going to get that attention, that extra attention. And you're just basically trading in the alley with retail traders, fucking betting on which flea can jump the highest. All right, market is open. Rates are a little bit elevated again. Let's see, the 10. What's the 30 you're at? Might be still at 5.1%. Still an excellent buy on the bonds. Yeah, you like to trade every day. That's fine. A day trader can be a day trader, but it's a different style of trading all around. All right, what is the market doing from the open here? It is rising. So we have the gap open, upward type of movement, which could be a positive for the day. We might get green retracement all day. That kind of move could be what that's doing. But Tesla is dropping. The Qs are going up. And let's take a look at the S&P 500. And the S&P 500 is going up. So Tesla's the only thing going in the opposite direction. So we'd call that extreme relative weakness. So Tesla, pretty bad. Everybody else is going up. And Tesla just can't do it. That's relative weakness. If you haven't noticed my absence, no, I think I did, but I didn't note it. Now that I see you here, I'm like, it's nice to see you. But I can't keep track of every kindergartner that's out of the fucking playground. I mean, you guys are like my children, is what I don't mean to call you kindergartners, but you're like I treat you like my children. We're family is what I mean, I mean that in a good way, and I want the best for all my children. I have 7 kids, but I mean, with you guys, I've got, making a massive, even more massive impact on this solar system. We were just talking this morning with my kids about how we're all stardust because this solar system is actually the second solar system that's been here. Crazy to think about, but we are the remnants. We are the remnants of an exploded star. And actually, we might not be the second solar system, but we are the remnants of an exploded star. There was a star here before this star. And half of that star is everything else, like the planets and the gold and all the shit that it formed in fusion when it exploded. And the asteroid belt and all that. It's just interesting to realize that, a star is just basically before a star was pure energy, and then it moved into being hydrogen, and then that blew up through a fusion process. Created all the different elements that we live on today. And all this got started because I was talking about how the tides, they go up and down, and the movie Interstellar where they have the giant wave, that's close to the black hole. And we were talking about how the Earth is actually spinning into the water. Like if you take a cup of water and you fill it and you try to spin the cup, well, the middle water kind of stays where it's at. The deepest water, the water that's near the edge, goes with the cup kind of, but the middle water kind of stays where it is. Well, the Earth is rotating around all the water as well, and it's the water that's in the deepest parts that stays where it's at that sort of flows towards the shore, and then over into waves and laps the shore, right? It comes over. So it's very interesting that the Earth is turning into the water. That's how we got started on this stardust conversation. Anyway, the market now moving down, which is a bad sign. That's bad. It just couldn't stay up. And if it breaks on the cues below that pivot point, especially pre-market lows, yeah, that's not good. I'm going to go ahead. Well, shit. I want to get some puts, but shit, it's no trade Monday for me. So I'm going to keep myself in jail on Mondays. That's been my plan this year. Mondays have been the least performing day, and there's reasons for that. There's market reasons for that. And so I'm going to not try and trade what's happening today in the market like it's a Wednesday, because it's Monday. And Mondays just don't behave the way you want them to. And that's just something that I have to stick to in my rule set. No trade Monday this year. Yeah, that's right. He's the one who got me thinking about that. Kind of interesting idea about the Neil deGrasse Tyson, about the ocean and the earth and the tides and all that. But, he sort of simplified it to the point where it was a little bit kind of ludicrous the way he explained it. I tried to explain it to my kids a little bit better, and you guys a little bit better, in that, the deeper the ocean, the less that water's going anywhere. I mean, just think of a water drop in space the size of Earth, and we're in it, and we're a landmass that's in it, and then because of tides, it turns oval and exposes some of the inner Earth. Well, when we're turning, obviously the water that's touching our mountainous Earth inside is getting all splashed up and everything, but the water that's at the deepest parts and the most pulled out parts tends to stay there because it's got no resistance. It's got nothing to be rotating for. It just stays there. Or let's say it drags. That's a better way to put it. That's interesting. TPST is moving up again, says somebody, but there goes the S&P 500. And I just love how this market is bleeding out. Yeah, TPST is moving, but TPST is so high in its ADR, 50% every day, that it's beyond a coin flip. It's very bad. And yet it's behaving a little bit. I mean, but the thing is, you can't really get much out of it because you have to risk very small because of the high risk of it. Right? But, if you find the right pattern on it and get an entry, you could get a nice risk reward going. For example, if you put your stop at the bottom of this recent bottom, $4, let's say, right now you could put on $1 of risk, and it's at $5, and with 50% ADR, maybe it goes to $7.50. 50% ADR, maybe it goes to $7.50, right? So $1 of risk to $7.50, $5, that's 2.5 to 1. It's certainly not Paul Tudor Jones level risk. But it's, it's okay. It's not bad. Anything over 2 is okay, and 3 is certainly good and better. And then 4 and 5 is outstanding. Anything. Sometimes we find trades that are 10 to 1. And yeah, they don't work out, but you only need them to work. They don't work out very much, but you don't need them to work out very much because they're 10 to 1. The thing is, if you can find the situations and the opportunities which also look like they have no risk on the downside, and yet still you have to place your risk to stop. Of course, you got to plan for the worst, but the probability, if you can get things set up to where the probability of that risk happening is very low, then you're always putting yourself in better situations. That's all there is to that. What? People think it will be a LGVN. I'm not touching TPST. I didn't. It from 62 cents something. Okay, well, all right. I can't fully understand what you're saying there. That's okay. All right. That's the way things are going this morning. TPST obviously back on the radar, and then LMDX failed. It's not happening. A quick look at HARP and GRTX. Yeah, both of them failed as well. I mean, this is just, the market is just bleeding out right now. If we were to look at the candlesticks on the market, they look like, and then of course Tesla is getting the assist from the market. Yeah, we are now. Are we below that? Yeah, we are breaking below pre-market lows and pivot points on the market. So this is, continued downtrend. It could be 1 or 2 or 3 days more down from here, or it could be up and chop, and then it just puts in. We could wedge this out. Like, let me draw that real quick for you, so you can get an example of what that might look like. This could end up going like this. Watch what I draw here. This little mark here wasn't the wrong spot. There we go. So, we get a descending wedge form coming into the market. That could definitely happen until it meets up to 200 mid-December, and then finally picks up the pace. But yeah, it's second half of the year, and regardless, the first half of the year was so good, such a huge run. And it was to the exact, July 1st practically, 51% gains on the Q market, on the Qs, on the growth market for the first half of the year. And then, so far, as bad as it is right now, as bad as it feels, does it feel bad? As bad as the market feels right now, it's only down 9%. Off of a 60% motherfucking run. And so far, we're only in halfway through, or more than halfway through the last half of the year. We're only down 9%. And this is at a very bad point. I mean, it's been down 5%. It's been down very little. This is a very healthy, constructive movement going on in the market, sussing everything out, getting it all in coordination with the economics until finally it can get to that optimum point where everything's been discounted and there's nothing left but upside. We're still not there yet, but it's coming, and it could be in a month. It could be December, and in fact, it could be even January, February of next year. And then, of course, like I've been theorizing, I think 2024 is going to be a pretty flat, choppy year because we're still going to wait to see who wins the election, and whoever wins the election in November dictates the kind of business environment we have, the regime that we'll have. Is it going to be more Wendy's and Taco Bell, or is it going to be more Amazon and Tesla? You know what I mean? There's two different kinds of candidates we have here. All right. And on that note, let's go back into the group. Hopefully that orientates you, and we're ready to start this week of trading up on, as aware as we can be. Thank you, everybody. Have a good morning, and I'll see you in the group. See you soon. You're very, very welcome, Bob.